Hello, everybody. Thanks for tuning in for another geopolitical analysis video. Please like and subscribe today's video and analysis. Share it to anybody who you think might be interested. Let's push and drive this channel towards the end of the year and give it another go. We've got some new subscribers. I appreciate that. This is our fourth live update series where we dive into anything that has transpired in 2022 that needs some analysis or any opinions out there that perhaps you don't hear in the media. So this is something that we'd like to cover here. And it really helps to drive the channel and the video because we do a lot of research just to make sense out of these macro environments, these global events that take place. Ultimately, it is a tool to make sense of it all. So I also, in turn, learned from this. So this is great. I had a few questions for some people who asked me, hey, what are your credentials in doing this and why do you have this channel? So I started a few years back and I started as a hobby, but the reason why I got into the analysis side of things of all these global macro events is because I have a history and tangible experience with this. So for instance, I served in the special forces in Greece for a year. That gave me really good exposure to the military side, to certain NATO events, because I was translating sometimes for some officers. But that opened the doors for more. I traveled to more than 23 countries. I served for a year as a maritime officer to secure with, it was a joint venture of private security groups where we secure the sea passages, high-risk passages of the Indian Ocean. So that made me look into different things that happen outside of the available experience that most people have with politics and geopolitical events. So it really gave me an insight into the relationship of countries, especially troubled countries, and things that we don't really get to see here at first hand of experience here in North America or in Europe. So it was very eye-opening. And that's what really opened the door for me and really made me more interested in this. So now that you know, please subscribe again, like this video, share it to everybody. I want to give you guys a rundown of the purpose of today's video. I want to continue until the very end. Essentially, we're doing a light digest of certain topics so we know what to expect for the next year. This video today will get into the Federal Reserve meeting that took place today, and also some other global events that have taken place that are some interesting some interesting events that I think would be very good to get into. Now we have some reports that I'd like to mention, and just to give us a little bit of a clear idea of what is to come in the next year and onwards, right? So that is in essence what we've been doing with every series here with the new live update. So let's dive into my recitation here, guys. No further ado. So the Federal Reserve, I watched the entire speech of Jerome Powell, who is the chair. He's one of the most powerful people right now in the world, right? Always has been, but as long as he's been serving, of course, for the Federal Reserve. But he is in a position right now where a lot of questions are being asked. And the Federal Reserve is essentially a private organization operating within the US. There were many people who were against the forming of this new Federal Reserve. I believe it was JP Morgan who started it with other bankers. I forget the date, but they really were pushing for a Federal Reserve which would really be responsible for pushing through a lot of these mandates, which are, we know, labor statistics and the inflation number. These are the primary mandates. Hey, John Paul, how's it going? These are the primary mandates of the Federal Reserve. So I saw the entire meeting today. What I saw was a man who is really sticking to his guns. There's been a lot of talking. When you're in the centerpiece of attention, you get a lot of perspectives. There's so many pundits around there. There's so many other people who are really projecting what the Federal Reserve is going to do. Are they going to increase or are they going to decrease? What are they going to do? And essentially, you get to see the psychology of the markets, and the markets have been addicted to free money. And because they've been addicted to this zero interest, and always that era of since 2009, as we talked about with Obama administration onwards, the printing of all that money and rescuing all these firms, there is this perception that all of a sudden, oh, it's gone too high. They have to go back. We're gonna go to lower interest rates. They will save the day, and the stocks will rally again. That's not what he's been saying, though. And I want to point out certain things that he said verbatim. So he said we're looking at 3 buckets of inflation: the goods inflation, rental leases, and labor statistics. He did hint to the fact that these buckets of inflation have a lag when it comes to policy, meaning that just because they push for the interest rates to be at a certain percentage doesn't mean that the response is automatic. It may take 6, 12, or even 2 years. So 6, 12 months to 2 years. So when he says this, and he says that our mandate is sticking to 2%, essentially he's trying to tell the markets that, hey, you got to reel it in a little bit, because we saw the markets really rally ahead of the meeting today. So of course he had to present himself hawkish. And I really truly believe that he's in a position where he doesn't want to repeat the mistakes of the other chairman before him, especially in the 70s when the country was going through inflation, high inflation. They don't want to go back to the same mistake where they reverse and pivot too soon. But the question is not when they're going to pivot, but how long will these rates be there for? Because the next meeting is projected to see another 25 basis points, so 0.25%. And that will make in total a 4.25. I believe that's what the interest rate is going to be in the next month. I have it somewhere here, but yeah, essentially the interest rates right now of the U.S., the federal funds are 4%, right? 4.25%. Yeah, 4.25%. So next year it might go 4.5%, right? That's sort of what they've projected. They've kind of telegraphed to the people in other speeches. And what he said was that what they want is, although the labor market is very strong, it is a lagging statistic. The rental leases, again, they're seeing that when they're up, the prices are dropping. Sure, there's an elevated interest rate there, but the prices are dropping. It's not translating right now. In terms of goods, as we've noted before, is more on the supply chain problem that the Federal Reserve cannot do much. They don't print milk, they don't print oil, they don't print all these commodities. Supply chain is something that gets broken over time, but has to be rebuilt and usually gets much better. And we're in the process of that, especially with automation kicking into much higher gear. One thing it was very interesting he said, because they were trying to corner him so he can give projections if we're heading into recession. He said, my focus is on what Congress has given us. Congress has assigned us to decrease inflation, and that's it. Essentially, he's saying that he's throwing the ball back at you in the court and saying, hey, the Congress are your people. You vote for these people. Parties vote for these people. And what they're telling us is we got to bring inflation to 2%. Whether or not that's going to happen, that's an entire different ballgame. A lot of people and pundits are saying that this is not going to happen. they're going to have to revisit and see a 3-4% benchmark. So yeah, so given where we're at right now, I think these are very important notes to take home with, that interest rates could stay there for a year, and we might not see them pivot until 2024. They're going to have to bring some deflation in order for us to see prices go down. They don't want to repeat the mistakes of the 70s where they pivoted too fast and then inflation came back again. So we have to be very cautious in these statements. And I was very interested to take a look at what was said, because a lot of questions were talked about supply. He didn't mention a lot of that. He didn't mention the lack of productivity, the supply shortage, and the lack of demand. But he talked about these three buckets of inflation. He insisted that this is the primary expectation and that they're committed in bringing it down. So you shouldn't fight the Fed. That's what they're saying. And especially when the Federal Reserve comes out there and says, this is our mandate, typically it goes how they want to, because they're in a position where they can control not only the US economy, but they can control many other areas in the world, markets in the world that handle USD. So you get the idea here, right? Everybody's flocking for the US dollar. Of course, the US dollar is not as strong as it was. The Dixie chart that shows the strength of the US dollar, it reached one of the highest, the all-time highs, which $114, 115 actually. So we're in a sticky situation where even if inflation comes down, because inflation is caused by supply chain in this situation, with this type of inflation, it will come down, but the cost will be something that we'll have to bear for a little bit. And that's going to be probably a deep recession, where we will see a total devaluation of goods, services, assets, what have you. A lot of wealth, like I've said before, trillions of dollars will be vanished. Poof. Now, moving on from the Federal Reserve, I want to talk to a few reports. Now, we had some interesting reports that came out with the Bank of International Settlements, the BIS, essentially came out saying that there is close to 80 trillion US dollars off the balance sheet of banks. So this is non-banks. It's not what banks owe, but other forex exchanges that owe 80 trillion US dollars. From that, I don't recall the percentage that is owed to the US, but these are forex markets that leverage, that borrow American dollars. And in this case, this is the shadowy part of the shadowy economy, right? Where we do not see these dealings because a lot of these are swaps. And this is an all-time high, and this is very scary because we don't know what's going to break. Because at some point, when you owe that much money, and especially with this contingent of the lenders, because right now you really don't want to be a borrower with the interest rates, right? So given the situation now, these are uncharted waters. We don't know how this is going to affect the price, the value of the US dollar, and we don't know how many defaults are going to occur because of that. 80 trillion, that's, I believe, the global, what is the global economy valued at? 100 trillion, 300 trillion. Yeah, let's take a quick look at it. Yeah. So the global economy in trillions yeah, is is well over 85 trillion. So it's around, like I said, it's around 100 trillion, a little bit more than 100 trillion dollars. So from that, you add all these crazy numbers that we hear from the Bank of Settlements, international settlements, and you get to understand that the world is in a very entangled place where you have uh, private entities owing outside of banks, and yeah, just I'm really curious to see where we're going to go with this, because at some point something breaks, right? You can't go on with this enormous amount of debt. Um, so one thing I want to bring to your attention, guys, is the Qatar thing. So with Qatar recently has been on the spotlight for all the wrong reasons. Apparently, of course, their lobbying takes place, but they were trying to bribe and get long-term contracts for natural gas, and there was a lot of misconception there from certain members of the European Parliament. If you haven't done your research on this and you think to yourself, well, Qatar is just another country, Europe has broken off from Russian gas now and oil, right? That's not truly the case, but slowly they're weaning off that dependency that they had. Qatar seems like, hey, it's another country. Let's take a look at their commodities. Well, in this case, Qatar and Russia are in bed with each other, energetically speaking, of course. And what I mean by that is that the executive board, I believe the president of the executive board of Rosneft, one of the biggest energy companies out there, Russian, of course, has a Qatari head, Qatari member. So Qatar has invested many, many millions, hundreds of millions into Russia's Rosneft. And now the European Union is having talks with Qatar. It's essentially the Trojan horse of Russia to supply Europe. And Qatar, aside from it being seen as one of the competitors of Saudi Arabia, and there's a lot of competition going on there and a lot of darker things that take place, especially in that part of the world. But how do you not know that Qatar is deeply invested with Rosneft? They're energy partners, right? The chairman of the executive board is from Qatar, right? I forget his name, but you can look it up, Rosneft. And you had, of course, the Eastern German front of the Eastern German politicians who raised that side of Germany, of course, after the Berlin Wall, etc., and the unification. Those, like Chancellor Schroeder and others, became part of Rosneft. And it's up until a few months ago, he was still part of the board until he actually stepped down. Where am I going with this? Well, we see that we're now looking at formations of different countries that are actually forming their own alliances and breaking off from this so-called free market, open trade, and forming alliances, blocks like they did in the 50s or the 60s, where they will be able to do their own transactions and not have to go necessarily from the same system. The SWIFT system of the payments system that it has the entire world is a part of. Also, there are going to be blocks that will break off from certain sanctions, backdoor deals, in agreements that will not be in US dollars, like we've seen the formation of BRICS that is preparing different forms of payments. Now, in this case, we have to ask ourselves, didn't the European Union see this? Didn't the members of one of the biggest economies, the third biggest economy, I believe, in the world, see this? The Qatar is in bed with Russia. How can you say we don't accept Russian commodities? We blacklist them because of their invasion in Ukraine. But Qatar has literally invested in the Russian field and you bring them in. So this was the members of the European Union fell into a trap. And this is a trap that it contains a contingency of Turkey, Azerbaijan, Russia, Qatar, and other players in the region that are trying to get a chunk of the market share. Okay, so we talked about the private and public entanglement of the 80 trillion, the forex swaps and the off-balance sheet debt there. We talked about Qatar. We talked about the Federal Reserve. So now I want to talk about the BlackRock 2023 investment playbook. The long-term investment apparently is something that is not going to be the same again. This is going to be a market where swing traders profit, where you're going to see a lot of volatility, but it's not going to be an easy pick 2-3 stocks, leave them for a year or two, and you'll get like a decent return back because the economy is growing. So there's a lot of liquidity in the market. No. So very interesting to read the investment playbook and how global equities, global markets right now will see that liquidity come to them. So there's going to be a recapture of American funds and just foreign investments that will leave North America and will go to other places. South America is a very fruitful Brazilian economy. Is looking like it has a lot of opportunity to gain some momentum there, a lot of room for growth. The Asian markets, a lot of these markets were for several years lost the spotlight. And this is just a natural play. So BlackRock, which is one of the biggest fund and handling firms in the world, have presented an investment playbook. But if they're wrong, this could be also catastrophic because the global outlook is that we're all heading towards a recession with a slowing of the economy. So either we're all going to move into a much more stronger global chain where automation takes place into incredible heights, and we see that UBI takes place, the universal basic income, which is a very good topic to discuss. Or we're going to see a total deglobalization where we go from the American epicenter, the corner piece of global markets, of investments that are in American dollars, break off and form different blocks that have different forms of payment where the US cannot monopolize the currency. So in this case, we have to look at this and understand that our world potentially might change. We might see changes that are going to affect us in a way that in the beginning are going to be really hard because we're going to see deflation. The only way to tame this inflated price of everything, the bubble of everything, is to see deflation. Things have to deflate. It is something that the Federal Reserve is hinting at. And I think that the lags of policy are going to be presented to us, and we're going to understand in the next few months what is to come. And a lot of people say, you always mention what is to come, what is to come. So what is exactly this recession you talk about? Well, let me be specific. You're going to see job cuts. You're going to see, now we've seen a lot of technology job cuts, but we might see in other manufacturing sectors and other parts of the industries that so far haven't cut any jobs, they might start laying off. Then we go into assets. You have any assets like a house, stocks? What else? Could be commodities that you hold, or it could be company shares or what have you. The price of all that is going to go down. There's going to be a revaluation of that. So automatically, there's going to be a loss for many people. Cash, of course, is a very good position right now to hold. If you can stomach the inflation and just hold cash until good opportunities present themselves, that is a really good advice that I've received from many. Because there will be a lot of standard names that have a really good cash flow that will be able to withstand this upcoming recession. I think that's it for today. I want to do a light digest. I don't want to go over 30 minutes. I think this is a bit too long. We had a few people, but seems that some of them exited. But thanks so much for subscribing to the channel, liking and commenting on the video. I appreciate your support. Again, I give you guys a little bit of background of my interests, why I got into this, and where we're going with the channel. We definitely want to see this grow, and we want to increase the membership. So please support this channel. Send it to anybody you know, and I'd love feedback from you guys, where you want to go next, what kind of topic. We might do another one on the weekend. If anything goes wrong, you might see us earlier. But yeah, thanks so much. Hope you're doing well wherever you are. Geopolitical analysis. Peace out. Bye for now.